Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Twilio was one of those hot SaaS stocks during the pandemic, but the stock has really come down to earth. And I think it's worth investors at least looking at, is this something that we should be buying for the future? Or is it a stock that's worth staying away from? That's what I want to dig into today. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content and check out my newsletter, Asymmetric Investing, below, covering a lot of high potential stocks there. And looking at Twilio, I want to go back through the company's financial results. Now, if you're not familiar, this is a company that makes APIs that other companies and developers can then use to do things like text or email customers. The way that I actually like to think about it is those spammy texts that you get from the dentist or a car dealership. That's actually probably coming through a Twilio API. So that's what their business is. That's what they've really grown on. This is their revenue over the last couple of years. You can see that revenue has grown steadily, but the growth rate on a year-over-year basis has actually declined steadily since Q1 2022. And on a quarter-over-quarter basis, revenue was actually down in the first quarter of 2023. So as much as this has been a growth stock in the past, it's not currently a growth stock right now. There are some things that management is trying to do to get around that, growing in data and things like that beyond just the APIs that they have. But right now, revenue is not growing. On an organic growth trend, the numbers are very similar. There were some acquisitions the company did previously, so the decline in the growth rate doesn't look quite as bad on an organic basis, but you can see that the growth rate is still falling. If we look at the company's income statement, you can see a couple of reasons for concern off the bat. First of all, revenue a little bit over $1 billion in the first quarter, gross margin only $490 million. Now, this is a company that's built on AWS. So they're paying a lot of costs to be hosted in the cloud by AWS. That's eating into gross profit. And unlike a lot of SaaS companies, the gross margin is under 50%. That should raise alarm bells for investors. You want to have that gross margin number be 70 to 80%, because then you have to pay for things like R&D, sales and marketing, general and administrative, all of these massive costs that go into the business. At the end of the day, Twilio lost $342 million in the first quarter. There were some caveats there. They're cutting expenses. So there were some impairments and restructuring costs. We would expect some of these operating costs to be a little bit lower in the future, but still losing money. There is plenty of cash on the balance sheet, $3.3 billion in short-term securities, $600 million in cash, so nearly $4 billion in cash on the balance sheet, but there is about $1 billion worth of debt, which you can see right here. And then if we go to the cash flow statement, the one thing that I really want to bring up is this line item right here, stock-based compensation. $171 million is what stock-based compensation was in just a single quarter. So about 17% of revenue was stock-based compensation. Now, management has said that that's going to be reduced in the future to 10 to 12% of revenue. But that means that the company is giving away about 10 to 12% of the stock, and it'll have to grow 10 to 12% just to have no dilution. That is just a crazy amount of stock to be giving to employees. And what management is actually doing is repurchasing a lot of the shares that they're giving away to employees. So $115 million in stock repurchased in the last quarter. The reason the weighted average shares outstanding is only up about 6 million to 186 million over the last year is the company was actually buying back stock. So they're issuing stock to employees and then using cash to buy back the stock that they issued to employees. The other option would be to just pay employees more. And then it would be a little bit easier to read their financial statements, see if they're actually making money. With any SaaS company, what you want to see is upfront investment in building out a product, and then you want to see that product scaling over time. What we're seeing with Twilio specifically is that revenue is actually starting to come down. So people are canceling subscriptions or downgrading or using them less. That's not the kind of trend that you want to see for a SaaS company, particularly one that's losing money and burning cash. And on top of that, Twilio is giving out an incredible amount of stock in stock-based compensation. As a result, this is just a stock that I would absolutely stay away from. Even if you think this is a product that's going to be growing in the future, I don't see any indication that management has intentions of being cash flow positive or being shareholder friendly in the future. So as a result, As investors, we don't have to buy every stock. We can just stay away from this one. That's what I am doing right now. But love to hear your thoughts on Twilio. Leave your comments in the comments section below. Don't forget to follow Asymmetric Investing. Thanks for watching, everybody. See you here next time.